Welcome back to another episode of FPOG, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're doing a little bit of a bonus episode. So I am running solo, and what I want to do is continue the conversation, the topic that Nathan and I covered. I think this was a few weeks ago. So it's the three paths, career paths within oil and gas. And I want to give a little bit more context and thoughts on those. I want to dive into even a recent, client discussion that we had that examined, hey, I'm kind of a solo owner, solo entrepreneur, and how do I make sure that my path financially is better than working at a major or a super major? Also want to give some of my own experiences on the topic. I don't own an oil and gas company, but I do own a wealth management firm. And I did kind of make the decision to go from a very terrific, stable, number one type path to use our analogy from that podcast. And I decided to give that up, start my own business, and want to talk about some of those things. And we received a fantastic question from a listener. I want to dive into that question and answer that. So let's start there. And I think most relevant or most helpful would be quick recap of those three career paths and what should you be thinking wealth management wise if you fall into one of these three career paths. So as Nathan and I discussed, within those three paths, number one and number two are pretty similar in that you're probably working at a big company and you're probably at a major or a super major, and you have either a really good income or an absolutely tremendous, fantastic income. And then those two are, relatively similar, but number three is pretty different. Number three is you're a founder, you're an entrepreneur, or it could also be, you go to a much, much smaller, privately owned business and you have a meaningful ownership share. Take this, for example. If you're 28 years old today, guess what? You're probably never going to own 4% of ExxonMobil. That's probably not in the cards, right? But you can make your way into a very small company, own 4% of a small company. And after 25 years, some of those small companies end up being worth hundreds of millions of dollars or more. And so the path on number three could be that you're the founder, you're an entrepreneur. It could be you're a solopreneur, you're a one-man shop, and maybe you're doing consulting or something like that. But it can also be you own a meaningful share of a small privately held business, and you're taking this path because you think your small minority share is going to be worth, 8 figures or more at some point. So those are the three career tracks. I will reiterate something I said. I think a fair number of people would disagree with me. Path number one from the podcast with Nathan and I, path number one, we said was you work at a major, super major. You eventually get income to $200,000 to $400,000 a year. That's a great income. And I made the claim that is the easiest path in America to make sure you have $5 million in investable assets. If you can just make $250,000, $300,000 a year, and you're not going to start out there in your mid-20s, but if you eventually get there and you put in 35, 40 years, unless something goes catastrophically wrong, you should get to 55, 60 years old, and you should be pretty close to $5 million. If two spouses do that, just as we mentioned, you can absolutely get to 10 million or pretty close. And then path number two is, hey, you find a way. Maybe it's you get your MBA, move up the corporate ladder. Maybe it's you go into a little bit more of a trading role within an oil and gas firm. So you're in a little bit different track with way higher income ceilings. But whatever the case may be, whatever the path is, you find an avenue to not make 2 to 400. You're making, 700,000, 800,000, 7 figures a year. And this is probably my more controversial take. I think that is the easiest path in America if you want to wake up at age 55 and have $10 to $20 million. And so a lot of the data would suggest if you want to hit 10 million or more, you have to start your own business. And I think outside of oil and gas, I would reiterate that as long as you live in a top 5 to 10 metro area, where there are an abundance of jobs that pay top 1% incomes, I think that is easier. I don't know if it's necessarily higher odds or anything, but I do think it's easier than starting your own business. So couple of the thoughts we want to share on this topic. So number 3 is you're an owner. You have a meaningful ownership share. You are foregoing. You're deciding to say no to option number 1 and number 2. And again, I think it's a big deal to say no to that because I maintain that it's about the easiest path there is to hit 5 million or to go above and beyond and hit 10 or 20 million. So if you're going to take path number 3, a conversation we had with a client recently who kind of does solopreneur work. And so total anonymity here, but a situation where this person is a solopreneur and they're making about $500,000 a year, early 30s. And the question and the conversation we had was, how do you compare this career track that this person is on? How do you compare that career track to, going and taking a role with any sort of major, super major? And how do you compare those? How do you make sure that, hey, staying in the solopreneur path, making pretty close to $500,000 a year is going to be financially better than taking, a role with Cosmos, Coke Industry, Chevron, BP, Shell, insert, any company that you've heard of here. And so the real nuts and bolts of it was 2 things. First off is you don't necessarily have to hit $10, $20 million when you're 60 years old to mean that it was worth it. And so financial planning should always be, what is the life optimal decision? That should be number 1. And so, in this position, if you have a young family, you have kids, and you want autonomy, you want freedom, it's okay to value that ahead of what your balance sheet's going to look like in 20 years. So that's number 1. You don't make every decision to optimize finances. But number 2 is, I'm still a CFP, so I'm still wanting to analyze, hey, what's your hurdle rate? What is the amount that you need to save every year in order to wake up in 20 years and say, you know what, this was financially better than climbing up the ladder at, maybe it's Shell or BP, maybe it's Coke Industries, or maybe it's insert, another 10 companies here. And the answer we came to was, if you put $70,000 a year into solo 401k plans, so some tax benefits for doing so, and then if you go above and beyond that, you do $5,000 a month into brokerage accounts. And so, this is a savings rate of $130,000 a year. You are effectively guaranteed to be well into the 8 figures 25 years later. And so, again, I'd reiterate, in that solopreneur position, there's 2 things to think through. One is, it's okay to make decisions that are not financially optimal. If they're life optimal, that's fantastic. But number 2, if that is the question you're asking, if you want to make sure that you're on a path that is significantly better than, working for a larger company, that's kind of a good investment savings rate to hit to ensure that you wake up decades later and you're financially better off. And so I think that's a great way to look at it. Another question we got from a listener was, if I want to pursue that number 3 path, if I want to pursue ownership, how do I evaluate whether it's worth it in the first 5 years? So when you start a business, the first 5 years are often pretty brutal. You're not making much money. Things are not clicking. And so if you kind of give a snapshot into year 3 of a business, I think it's more likely than not, even if the business has hit a point where it's probably going to survive. A ton of businesses fail within the first 3-4 years. But even if you look at a snapshot and it's a business that's going to survive, you're probably going to see a picture of a founder or a person who is in a much worse financial situation than if they had taken the safer path. And so how do you think through that? How do you know in those early years, am I actually going to get a payoff here? Is this worth it? And so just like I mentioned, in my position, I've had to think through those things. So my personal path was working at a giant investment firm, and I was squarely in path number one. So I was kind of in the oil and gas equivalent of path number one. Let's see, I was 28 years old, making just under $200,000 a year. And the thing about the company I was at, they had a 17% 401k match. Which is just truly absurd, but that also lines up with benefits that a lot of large supermajor oil and gas companies have. And had I stayed there, we, could have had a fantastic, secure path to really a great nest egg. And I was only 28. So, I do think my income would have grown to about 250, eventually 300, maybe 350. The thing about the role I was in, though, it was a great way to hit 200,000 a year. It was really, really difficult. It was very capped. It was hard to make more than 500,000 a year. Quick anecdote, quick story on that. So I remember this is 6-7 years ago. My wife, Lauren, and I think I'm going to have Lauren on the podcast soon. She is finishing up law school this week. So we kind of took this crazy path where we've got 3 kids in elementary school, and we decided, we want to have Lauren go to law school. She decided that, and I decided it too. We make decisions squarely together. And so I should have her on the podcast to get a little bit more of her insight of these early years. But we were looking on Zillow. And, the quick anecdote here is if you're familiar with real estate in the Woodlands, there's maybe 3 houses in all of the Woodlands that look like they're from Nantucket. So there's maybe 3 houses in all of the villages in the Woodlands that look like you're looking at a New England coastal style home. And so one of these homes came on the market. And I believe this home at the time was like $650,000 or something like that. And so we looked at this and we thought, we could buy this. This could be our forever home. And my wife loved this house, like absolutely in love with it. She had to have it. It's funny to look back on that now. I guarantee you this house is like 1.3 today, because this is well before the pandemic, well before every asset that anybody wants to own just went crazy high. And so we chose not to do that. And we chose to go in a completely opposite path. We chose to actually, and I mean completely opposite. So we were still living in our starter home. And we chose to sell that starter home, take all the equity out of it, and put it entirely in my business. We made that choice about a year in, after things were kind of already going a lot better than we could have hoped. And so we didn't do it blindly. We didn't do it on day one. We did it after there was significant proof of concept, and it was like, okay, I'm pretty sure we're going to wake up in 10 years and I should be able to 10x or more my income. And so that little anecdote, that story, is a little bit of the question we got. How do you know when you're in the first 5 years, if you're taking path number 3, how do you know if it's worth it? So 2 thoughts really governed our decisions during those days. Both of these were from Brent Bashore. I'll try to link these tweets. These are like 7-year-old tweets. These are timeless, incredible thoughts from Brent. He owns a private equity company in Columbia, Missouri. But they had a huge impact on me. So one of his ideas was the idea of a base rate. So here, I'm going to read exactly what Brent says. The average of how others do is the most likely indicator of my future performance. I want to get into situations where the base rate is attractive. That was the governing thought for us. I knew when I started Brownlee Wealth Management, I had significant experience working with clients that had, well into 7 figures and into 8 figures. And so I knew that if I can simply do that, but if I can control it, if I can own the entity, I'm going to get paid significantly more than my large, financial institution that I worked at previously. And so the idea of a base rate is, and I love, he goes into more detail on it, but the basic idea is this: when you start a business, a lot of people think that they're going to make a lot of money because they're going to be the best at what they do. They're going to be the top 1%. They're going to be a top 10% achiever in whatever it is you do. And so if you're starting an oil and gas company of any sort, or if you're taking a meaningful ownership position, if the premise is this will be financially better if we are a top 1% performer, I think that's a terrible idea. The reason why my wife Lauren and I, took some pretty drastic measures to start our business is that we knew even if we're really average, even if we're not that great at it, we are probably going to wake up down the road and be in a way better off position than I was at my prior job. So again, the question is, if this works and we're pretty average, we're really not that great, we're just super average, is it still way better off than taking a 35-year career track with Chevron? That's the question you need to be asking. I do think there's two types of businesses. One is a business you start with the sole intention of selling it. You have no intention of owning this business 20 years from now. You are building it from day one for an exit. Business number two is the opposite. It's entirely built around significant cash flow and cash flow that should be able to be enduring. So this is a business you plan on owning for 40, 50 years. That's my favorite type of business, much more than looking for an exit. I love businesses that people build that you plan to hold this for 40 or 50 years. That's entirely our intention. That is the DNA of what we want to build. And I think that is the perfect metric that you need to apply before you quit your, Supermajor job at Shell, BP, ExxonMobil. And I think that's the metric within the first 5 years to also apply when times are not that great. Again, the metric that I'm talking about is, if we fast forward 10 years and if we can survive, like if we can just survive and if we can just be average, are we going to be way better off than that 35-year career at Chevron? If you're going to pursue number three, the answer better be yes. So again, that idea from Brent Bashore is base rate. He says, I want to get into situations where the base rate is attractive. Said another way, I want to get into opportunities where if we are average, it's still really, really attractive. That needs to be true. The other difficulty with path number three, again, another Brent Bashore thought, non-linearity. And so Brent says, I expect orderly sequential outcomes, but instead I get compounding with unexpectedly positive and unexpectedly negative outcomes. Expect the unexpected. Get better at ballparking non-linear results. That's the crazy thing when you pursue number three. When you put yourself out there and pursue number three, if you're playing in the right arena, if you're putting yourself in the right environment, there are going to be non-linear outcomes. And those non-linear outcomes are why number three needs to have the potential to be far better off than number one and number two. So again, if you're pursuing an ownership stake, it needs to have the opportunity, even if you're just average, that, hey, this was better than climbing the ladder at, Koch Industries, Chevron, ExxonMobil, even if you're able to get really high up in those companies. The base rate needs to be that attractive. So I think that's the governing thought. Again, these are just some additional thoughts on, hey, if you're going to forego a more standard career, how do you know if it's worth it? And so hope this is helpful and love to dive into this topic more in the coming months. Thanks, y'all.